Today, let's talk about some tips on how to pay less tax on investments, because tax is possibly the biggest cost of investing along with the fees. I'm going to break it down into a couple of topics. First of all, I'm going to talk you through 2 general strategies that can help you save tax, and some tips on capital gain tax and tips on the dividend and distribution and any tax deductions as well. I understand most of us use accountant to lodge the tax return, but please feel free to take advantage of any of the tips that I'm going to mention in this video, so you can action ahead and save you money before you pass the statements to your accountant. So if this topic is something that you're interested in, please don't forget to give it a like and keep watching. When we think about investment, we automatically think of the investment account through a stockbroker. But don't forget about super as well. So my number 1 tip is to incorporate salary sacrifice to your super fund as part of your investment strategy. Because Australian government provides a huge tax incentives to help you save money to your super. That includes you pay 15% tax on the employee's contribution as well as your salary sacrifice. Although the salary sacrifice is capped $25,000 per year, and you pay maximum 15% tax on investment earnings and 10% on capital gains. And there's no tax on withdrawals from super for most people age of 60. And nowadays, many super funds offer very similar investment portfolios as those offered by the mutual funds on the market. And some of them even allow you to invest directly into stocks and ETFs that are traded on ASX. So here's a strategy you can consider. For example, you do dollar cost averaging of $2,000 per month. You can set aside, say, $500 into your super fund as the salary sacrifice. You can still invest the $1,500 into the stocks or ETFs or other asset classes as per normal. So in this way, you can save the tax on the salary sacrifice. And if you back calculate well, you may be even able to just bring your marginal tax rate into a lower bracket. Let's see an example to show what I mean. For example, you have gross income of $6,000 per month, and the scenario 1 is you pay no salary sacrifice and your marginal tax rate is 32.5%, and the income tax that you need to pay is $1,156. And of course, you pay Medicare levy payable 2%. So the cash into your pocket is $4,724. Scenario 2 is that you set aside $500 as the salary sacrifice. And of course, it doesn't change your marginal tax rate. So the cash in hand is $4,397. And you also need to pay the tax on the salary sacrifice, 15%. So the tax saved in total is $98 per month. Let's look at a more extreme example. Say you contribute $2,250 as the salary sacrifice. That actually will bring your marginal tax rate to 19%. And the cash in hand is $3,251. And the tax saved in total is $439.50 per month. If you do salary sacrifice, you will probably end up with less cash in hand. But this $500 or $2,250, they didn't vanish. They actually went into your super fund as investment, but you have to be careful of the $25,000 per year cap on the salary sacrifice. The downside of salary sacrifice strategy is that whatever money goes into your super fund, it cannot be easily accessed. So if you're planning to fire, you have to calculate the figure really carefully. So to make sure that you have enough fund to withdraw in the near future. But everybody's situation is different. My point here is to take a step back and see the investment as the whole picture and use salary sacrifice wisely to help you save more money. And my number 2 tip is to split the income between you and your spouse. And this is a very easy and effective tax planning tool that can possibly save the bulk of your taxes. What we can do here is to let the low income earner to have the investment assets, and likewise have all those tax deductibles such as charitable donations under the higher income earner. For example, if an investor who is on the top marginal tax rate of 47% had a $50,000 capital gain on stocks, he would need to pay $11,750. If the investment assets are under his spouse's name who had no other income, she would need to pay $1,627. That is almost $10,000 savings. Well, the example I gave it here is a little bit extreme, but the goal here is to try to level the income of the couples so that they are on similar marginal tax rate. If you find the content informative, please don't forget to give it a like. That will help my video to be seen by more people. Now let's look at the tips on how to pay less capital gain tax. By law, you need to add your investment income into your assessable income to work out the total tax that you need to pay. So what are they? They could be the interest from the high saving account or money market fund, or the coupon interest from bond, or any rent from your investment properties, or dividends and distributions, or any capital gain from selling the stocks or investment properties, or even cryptocurrency. Let's talk about capital gain tax first. So what is it? It is the tax that you pay on the profit that you bought low and sold high on an investment assets. And one thing we have to be clear is that for any tax purposes, any gains or losses have to be realized. That means that if you don't sell your stock, but the stock value goes up, you don't pay any tax on it. And this capital gain tax is part of the income tax. So it's not a separate tax. So if you realize a capital gain, you will pay more tax because this capital gain will increase your assessable income base, or it can possibly push you to a higher marginal tax rate. And how can we pay less capital gain tax? The simple way is to hold on to the assets for more than 12 months because ATO offers a 50% discount to individuals and small businesses if they hold a assets for more than 12 months. And this 12 months doesn't include the day you bought it and the day you sold it. If you foresee that your earnings will be lower than usual, for example, you're going on maternity leave or you're taking some time from work, then selling an asset in a lower income year means that you pay capital gain tax at a lower tax rate. Or in some cases, that there's a big capital gains in the portfolio that it might be a good idea just to spread the disposal along a couple of income years. Ideally, you want to hold the assets long term to enjoy the price appreciation. But in case you want to get rid of a losing stock, you will have capital loss. And capital loss can only be offset with capital gains and not other income sources. So if you plan to realize a capital gain, choose the year that you possibly have lost to offset the profit. One special tip on cryptocurrency: capital losses on personal use purposes will be disregarded. So if you bought and kept the crypto as the personal use purposes, you will not be able to offset the capital loss with the capital gains. Now let's talk about dividend and distribution. We get paid dividends as shareholders to share the company's profit. And you may have heard of franked dividends and unfranked dividends. And basically the franked dividends are the dividends paid by the Australian companies from the profits have been taxed previously. And any tax paid by the company is allocated with a franking credits attached to the dividend. Here is a formula how to calculate the franking credit. And the franking credit can offset your tax liability to any forms of income. So not only the dividend. So here is an example. John received unfranked dividend 200 and franked dividend 700. And based on the franking credit formula, he's got franking credit 300. Pay attention here. This franking credit must be added to the total taxable income. So that is 81,200. And the tax he pays based on 32.5% marginal tax rate is 16,857. And here you can less the franking tax to offset the total income tax. That gives him to pay 16,557. The company tax with turnover greater than 50 million is 30%. So my next tip is when you're looking to buy shares, pay special attention on the ones that offer fully credited dividends because 30% tax is already paid. So if your marginal tax rate is 32.5% or less, you almost get tax-free dividends. And my last tip is to take advantage of any tax deductible expenses. So any costs that occurred in getting the income from your investment are tax deductible, such as ongoing management fees or travel expenses, any travel expenses that you visit your stockbroker or attend a shareholder general meeting, or any journals or publications that you subscribe, or any portfolio management services that can be claimed against your investment income, internet access, telephone, of course, is the portion of the expenses that related to your investment, or depreciation on the proportion of the decline in value of your laptop and printers, of course, based on the percentage that you use them for managing your investments. One special tip is that you cannot claim the brokerage fee or the stamp duty when you buy the shares, because this cost will form part of the cost base for capital gain tax calculation when you sell the shares eventually. Alright, that's it for today. I'll be glad if you can take advantage of any of the tax tips on investment that I mentioned today. So more tax saves and more money into your pocket. Alright, I'll see you next week. Bye.